Good afternoon, everyone. This is Chris. Welcome to our monthly Connect series for premium members. Today is welcome to November, everyone, and we're less than 60 days away from Christmas, so I hope you got your list made. Hey, thank you for joining, and if you aren't listening to us live, we hope you can enjoy it at your own convenience. I'm going to go ahead and get started, but I do want to say that we may be doing another one here in a couple of weeks, and we'll get into that as per why, but we'll go ahead and get started here. As a reminder each week, you know that Kimble Charting Solutions is not a bull or a bear shop. We're just trying to empower you with money-making opportunities, but trying to keep our own biases, to the side. And boy, this may be one of the tougher times to keep biases for a lot of people, around the world. And the reason I say that is for the people in the States and around the world, there's a big election, and that'll be a week, roughly a week and a few hours away. We may know who won the election, but my take on it is if we do, if a winner is declared, next Tuesday night, I think it just kind of boils down to, is America really going to go the route of some change or just stay the same? And with that in mind, it's not so much to me everyone who wins next week. We all have, our biases and who we'd like to see and frustrations most likely, with both. But to me what it boils down is to this. It's not who wins, it's the reaction to it. Is it going to be the first guy with a little smug look, the second one is really excited, maybe the third one panicky, and the fourth one thinks, man, this kind of stinks, overall. So I can't emphasize enough that to me it's not, again, what takes place next week, it's the reaction to it. So let's go back, what would July be, roughly 90 days, but when the Brexit vote took place, it wasn't so much just how the vote came out, it was the reaction to it. And the reaction, one of the biggest reactions right away was in the currency markets. And I just want to say a week from now, I think there's a lot of, we'll go through the patterns or the stages are set for some potentially big moves in the currency complex. But again, currencies, the total accumulation of the United States dollar or the worth of the United States is much greater than the stock and bond and commodity markets in the States. And so to me, we're going to start off thinking about the currencies and even look back, 90 days, because this was the British pound. You'll notice this chart's from 2014. It's in a downtrend, lower highs and lower lows. But this, where the arrow came in, this is when Brexit, took place. And a pretty big move starts taking place, right in here, and we all know that the British pound just lost a huge percentage in a relatively short order, and I think it was just a matter of hours. I'm sorry if I'm wrong on that, but it just seemed to be awful quick, back then. And so I think the currency markets are going to be one of the first places that we're going to want to look to the reaction of the vote next week and some of the impact and ripple effects and how we can take advantage of that in several different asset classes. And so I think the stage is set that the vote next week could become the excuse, and it could be the excuse to settle a couple of key patterns. So when you look at this gentleman's face at the top of the screen, is he looking at you or is he looking away from you? Well, one of the things about, we all know that charting is, it's subjective. A lot of people I've honored and humbled call it chart art. But there's just a lot of possibilities that we all know, and I'm very humbled and honored that you give me a chance to share my thoughts today and daily with the premium members. But what we want to look at is I just want to talk about two patterns. One would be what we call a continuation pattern that you see highlighted in the lower left. So whatever asset this is, you can see that it's going up, and then it makes maybe a little bit of a lower low and lower highs, but essentially this is still in an upward trend, and then when it breaks out, this is a break of that continuation pattern. Some will call it a bullish flag pattern, and then you can see the red bars, everyone, that's the measured move. And so if it does break out to the upside, the objective is the size of the trend coming off from the left side. It could be measured then, that's how far it could break out to the upside. So this would be a bullish continuation pattern. On the flip side, we're all familiar with the head and shoulders topping pattern. So I think it was roughly 9 or 10 days ago that I shared this chart with you, and what this looks at is right now is the US dollar, and we're going to look at the bullish potential. We all know that the dollar, in 2014, for about 18 months, had a huge, strong rally. We can see it, coming up here. And then for the last 18 months, it's been pretty much just choppy action. So a case could be made that the dollar remains in this uptrend here. It hit the top of this resistance, but this is a bullish continuation pattern, and right now it's testing breakout levels. So the stage would be set after a huge, exciting move. We had choppiness in the dollar, a large move upward, and this was the largest 18-month rally in recorded history in the dollar, and now it's settled back after that huge move. So from the last 3 years, a person would say the trend is up, and so this is why it could be a bullish continuation pattern. And we'd all know that there's many ripple effects if the world, whatever the reason next week, no matter if it's Trump gets in or Hillary gets in, but if buyers would start purchasing the dollar for whatever reason, but if they would become purchasers and they'd break it out, that could give it a lot of room to run. And boy, if this would be a correct read, and you think about the measured move, this measured move was a 15% move right here in a short period of time. The dollar is about at 100 right now. If the dollar would break out and the read was correct and the measured move came true, that would suggest that a minimum move to the dollar of up to around 115. So a 15% move, we all know in any currency, is a big one, especially in the US dollar, could have a lot of ripple effects. So on the flip side, after such a historic move, is it possible this is the same chart, everyone, on the left and right, same falling channel, but now we're looking at it potentially as a head and shoulders top. To me, it's a little sloppy, but it's completely possible. That the only thing to me that's sloppy is just that the left shoulder is a little higher, but that doesn't negate the possibilities. You can see we connected several highs and lows, and this is what is really intriguing to me is if this read would be correct, the US dollar is right at or very near the apex of the right shoulder at number 2. So this is what's so fascinating, that the vote could end up being the excuse for these patterns that have been set in play. And even though this has been boring, the possibility of the huge moves and then the ongoing ripple effects, from the dollar could just be, fabulous in opportunity here. Obviously, the outcomes of these are bipolar, very, very different. So we're going to dig into, is there anything that's tipping us off to maybe which pattern is more likely? So we'll get into that now. But here's just a reminder, we'll clean it up, we'll just look at the dollar. And again, this is the US dollar monthly going back into 1989. And just very simply, you can see that there's a possibility that this is a head and shoulders top pattern up against falling resistance. And you can see the reversal wicks here, a very small one here. Now again, this is a monthly chart, and so you can see last month the dollar had a huge push up, and it pushed right up to that channel line and stopped on a dime. So this is why I say this has the potential to be the apex. So if a person was bearish the dollar for whatever the reasons would happen to be, this would be an ideal price point from a risk-reward perspective to short the dollar right here and just give it a little bit of a risk up to the 100 level. So it's trading around 98, so that's roughly about 170 basis points upside risk. You put the stop right above 100. So this is very much a possibility with the dollar, but I wanted to kind of clean that up just so you could see what the dollar looks like alone. The thing that gets me is if you turn this to a daily chart, this pattern, because of all the choppy noise, tends to disappear. Hard to see it here, and I apologize. I'll get this to you, later on, but this little notch right here on the right side, that's the close. So there's the chance that that's the left shoulder with the head, and then if you'll notice the close on the right shoulder is almost parallel to the left. So again, it could be looking for an excuse next week just to finally bust out of this pattern. Some of the potential ramifications if the dollar was topping and it's ready to go down, we're looking at gold in the upper left, GDX in the upper right, and silver in the lower left. And you'll notice that all of them do remain in falling channels, but they're also hitting support of the channels that they've created this year. So they're all testing support right now at potentially the exact same time that the dollar is at the apex of the right shoulder. So if we see the U.S. dollar start turning weak, you could see strong rallies in this metal complex, in any of these. And I imagine most of you are aware by now, silver had a pretty darn good day in the lower left today. One of its better ones in a while, up over 300 basis points, and I think gold was up over 100. So one of the things, what we've been talking about currencies, again, that's important, this is the Swiss franc here in the lower right. Again, it is being compressed by either a descending triangle, or I didn't bring the 10-year support line, or a pennant pattern coming up, everyone, off of these lows right through here. And we've been discussing this every week in the metals one. So again, another tip to maybe how society reacts could come next week in the franc. So the franc could give us a confirming or anti-message to the patterns of the dollar. So again, as we look for election results, I would encourage you to really start watching some of these currencies. Even if you don't trade the currencies, it's the ripple effects, I think, that could be the greatest opportunities for all of us. So speaking of currencies, and maybe one of the most important ones to me, here's what a 33, 34-year snapshot of crude oil on a weekly basis. And for whatever reason, you'll notice that there's a chance that there was a double bottom down here. And then since this second double bottom in the late 90s, you'll notice that there's just an upward slant to this picture of higher lows and higher highs in crude oil. Earlier this year, it came down and hit this support line, which was a parallel that's been in place since the last 15 years. Reversal wicks took place and it's rallied up. So to me, the key for one of the most important commodities on the world, in some ways, some people express crude oil as also a type of a currency, is this resistance line, which is potentially the neckline at 50. So there's two different important pieces here. Crude is banging its head on the underside of this long-term channel right up here. And so what it does up against that, this is resistance. I mean, the trend is still down in a long-term basis on crude. Ever since it's been over $100 a barrel, it's created a series of lower highs and lower lows. And I'd have to say this is one of the bigger tests in a long time, because this could be a long-term reversal pattern taking over a year to potentially form. So we have hit this neckline just in this past week. We'll go into a couple of charts later on, but one of the things that if the inverse pattern is to come true, a person would not want to see bearish reversal patterns or bearish wicks at the neckline. You'd want to see a breakout. So far, last week, last month, you'll see both in upcoming charts, we did see bearish reversal patterns right at the exact price point where you would, if you were bullish, you would not want to see it happen. So I'm not bullish or bearish on this, other than just there's a lot of opportunity here. Again, as I've reiterated since July, when crude was hitting $50 in July, we said, hey, it needed to back off to form the right shoulder, and it did. Potentially it came back in the lower 40s, now we're back at 50 again. So what it does in this 50 to 46 range, if it can break out and get into this upward channel, the measured move we've seen discussed, if you take the height from the head to the neckline and apply a measured move, if it would break out, the measured move would suggest that crude could rally up to 100. So if the dollar in one of the earlier charts that we looked at, if the head and shoulders topping pattern would be correct, that could mean that this is a inverse head and shoulders bottoming pattern that would fit very nicely for some very, very large moves in these. So patience really plays out, because if these are true, these moves, when they would break out, will probably run for quite a while. So I think our waiting game is pretty close to being over, everyone. So here's a look at crude. Now they're both the same charts. The chart on the left is crude on a weekly closing basis. And this is this potential inverse head and shoulders, but all I want to do is focus in these two charts is on the potential ascending triangle in both of these patterns. An ascending triangle is characterized by flat tops and higher lows. So talking about important, you can see the weekly closes, here would be the left shoulder and the right shoulder and the head, but this green line is the neckline, and you can see last week it actually, or the week before, excuse me, closed above that. I did buy into it, and I put a tight stop, and last Friday we got taken out because I didn't want to get beat up much in case it would fail, and I think we were out of it, and what was it yesterday? It fell over 4%, I believe. So an ugly start to this week, and so this is where some really important stuff goes on. This is the same chart again, everyone, with the candlesticks, and you'll notice that this neckline coming across here, you had this reversal wick, here in 2015, where the left shoulder up to the first neckline price was formed down to the head. Essentially, here's another reversal pattern, almost right at that same price, down to the right shoulder, and it's chopped back up. Now here was the test of the neckline. That was a couple of weeks ago. You see a small reversal pattern, and we've had some weakness. So the blue lines on the underneath, everyone, are drawn or based upon the monthly closes. So this blue line is the same on both charts. So you can see today where we have closed, the week obviously is not closed, but as of very close to Tuesday's close, crude oil is right on this line. So what would be the ideal price action for the inverse head and shoulders pattern would be to break the support line by a little bit. Could come down here to the 45 range, a couple more percent, and create one of these. That would be the ideal, is to try to break this support line and reverse it around and create another bullish reversal wick right at support. So obviously that has not been proven, but this is really important. So you can see that essentially between 46 and 50, crude oil is in a jam between support and resistance. Is there a possibility that next week is finally some news that breaks this? Anything's possible, but folks, if the correlation, even if the correlation between stocks and crude ends, this is a very important pattern for many of the energy plays that we have been discussing. Very important what happens right here, everyone. So this is the US dollar, and here's the chance. I just kind of wanted to show you something. We've just discussed the potential inverse head and shoulders. Well, the top chart is crude, and then you could see potentially the polar opposite. Now these are both monthly charts. So we're going back almost 20 years. So you notice that there's a chance that the dollar is, or excuse me, that crude at the top is creating this reversal pattern. And again, it's in a downtrend. Here's this monthly wick last month that I said that's not what you would want to see at a neckline. You want to see them reversing the other way. So people tried to buy it and push it up, and it failed, and it came back down. So kind of just looking for other clues. Do you notice anything about right here and then right here? So here's your bullish wicks in the crude as it was bottoming, but you'll notice the dollar was making a topping pattern, and it wasn't making huge wicks like crude was, but there were some small ones, and it was creating a topping pattern. So does this look a little similar? That we've got these monthly wicks here, and then we've got a couple of reversal wicks on the flip side. So this doesn't prove anything, but I'm just really, it caught my eye that the last time we had a major bottom on a monthly chart, what did crude look like then, and what did the dollar look like then? And we see some parallels, going on right now. So it could be important to give us some clues. Again, this was now this is crude monthly. I highlighted, I'll share with you later about that wick, and there was last month. And so that is, from a scoring on defense or from a bearish situation, bears would want to see this. You would want to see failure at a neckline. And so right now, especially being a monthly chart, you can see here was your highest close right here, and here was your another highest an equal close. But each of these times that it's tried to break above that, you've seen these reversal patterns. So there is a lot of selling pressure up there. But some of those people could be really fooled if it would really happen to bust out. But right now you can see that people are very anxious to sell at that neckline. So the neckline is very critical. There's your wick. You've seen this many times. This is crude oil in the red. This is the New York Stock Exchange in the black. And we're just going to highlight They have correlated fairly well in this time period. Then the market went flat and crude oil really tanked, so they didn't correlate. But now you'll notice inside this rectangle we've been highlighting, there's pretty much a look-alike pattern, and it's hard to tell who's the chicken or the egg. If anything, you can see a little bit of stock weakness right in here that it's taken crude a little bit. But here's the action that we've seen, just lately. And one thing that's just really important is for this right shoulder, if this is to take place, you would not want to see crude just coming down here and breaking below the low 40 level, because it could negate the whole pattern. So again, very, very important how these two are correlating and where they are right now. So if crude would happen to continue to be soft, if this correlation continued, you can see the same thing in stocks. From a big picture, we're speaking of currencies first, and then how it could play out to commodities. This is the TR commodity index, the Thomson Reuters, that we've been sharing quite a bit for the last couple of years. And so this is a snapshot looking back, mid-70s, so almost 40 years. And this is a potential we highlighted in July of 2014, that this is essentially one of the largest head and shoulders topping patterns that I had ever seen. And we highlighted that if it was true, it was at the right shoulder, and then we've seen this huge collapse in commodities. But this is whether even if this read is correct or not, the bottom line is, we want to look for emotional turning points. We had the high in the 1980s, the low in 2007 and 8 right here. You take those long-term monthly closes and you run them out, you can see that this year's low created a reversal wick right on that long-term support line. So that's would appear to be the neckline. Even if the read isn't correct, it's a support line. The rally we had off January has come up to the first fib level. And like I've shared before, as the central bankers are trying to make cheap money all over the world, it'd be kind of handy to see commodities start doing a little bit better, whether you played them or not, or whether you're in that industry or not, just because it might have a chance of representing the backbone or the confidence of people around the world. So we know stocks, even though commodities have went down, stocks have went up. So you hear me mention copper quite a bit. But in all humbleness, copper's been down since 2011, and the stocks have been up. So whether it is a solid indicator or not, we're going to discuss copper, how much it's gotten beat up, and some opportunities. I still do think that because if this measured move, if this is a head and shoulders topping pattern, and this is a measured move, and the neckline gets taken out, it's suggesting that commodities fall almost another 50% below this line. So I don't think, even though we can win a trading war, or a trading battle, excuse me, I think society would struggle from really a 30,000-foot view if commodities would break this neckline. And so really important, because if you think about it, here's almost that, crude obviously is an important component of the commodities index. It influences other commodities. Even in this broad-based index, which includes, 21 commodities roughly, there's a potential of an inverse head and shoulders, with the 23% fib level being the neckline. So there's a possibility of a reversal. If one of the earlier charts in the US dollar is a topping pattern, this could be very good for commodities, which have really still, even despite this rally this year, are way below where they were in levels in 2011. This is the same chart again, everyone, just going back even further. And from a power of the pattern perspective, you see these key turning points on a month. This is a monthly basis. So even if this is one point in time, to get a monthly chart to do that, most likely on a weekly, it spent more time there, and daily even more obvious. So a couple of key price points, resistance lines. Again, this is in a downtrend, and it has a lot to do, I think, from a macro perspective, but it did hit dual resistance. It's backed off. That could also be viewed as the same level as the neckline. So is next week going to be, or a couple of weeks from now, finally enough information to cause people to break from some of these, or break these patterns out? I think there's a higher probability, because they've taken quite a long time to form, and maybe some of the indecision might where people are using indecision or the unknown as an excuse. This year may be one of the times that it's really, really true. But again, I think it's the reaction to things next week, not who wins, that's important. From an interest rate perspective, there's all the Fed speak and the talk about are they going to do this or that, with rates. I still give billions of free-thinking people a lot of credit and a pat on the back and a high five that I think they still count, and the free market of late has been pushing bond prices or yields up a little and prices down. So I want to kind of just hit on this a little bit. This is the TLT chart that we have been sharing, weekly. We shorted TLT up here for a few reasons. It was at the top of this 10-year channel. Momentum was very overbought. It was at the top of this channel and also hitting a Fib 161 extension level. And so at the time that we shorted bonds this summer, it wasn't about, the last thing on my mind was what the Fed was going to do in any open market committee meeting or anything. Humbly, I just don't care anything about that stuff. But from a price perspective, we did short bonds here. We've seen some nice action, and we're actually even, TLT has broken this rising channel of late. We've sold a little bit of the position. We've been fortunate if you could own a bond all year. For all of you bond players, if you'd make 6 to 8% in a year, especially with yields this low, that's not a bad gain. We've been blessed, lately that we've made more money in the last 90 days shorting bonds than what the S&P has done, this whole year. So there's opportunities regardless, even in some of these choppy sideways actions. So weakness here, we'll just see how much it continues. We're going to, excuse me, I'll go back. We're going to look at the German Bund chart, which I still think is the most important bond message, on the planet. But I did see something today that caught my eye. We're going to look at TIPS, or inflation protection bonds. But you can see from the inflows, or traditionally, when money flows to TIPS, these are what people that want to own a bond, but they think some inflation will come back and strike. And this chart doesn't mean anything other than you can see that it was the third highest inflows towards TIPS in the last couple of years. So somebody out there, or some people's funds or whatever, but collectively quite a bit of money is moving into TIPS. Maybe it's a contrary indicator. There's all kinds of possibilities. But one of the things I wanted to show you was the TIP-TLT ratio. So what I did is, and you could do on your own, is just take the TIP ETF and divide it by TLT. The thing that did catch my eye is the ratio had collapsed, which meaning inflationary or inflation indexed bonds were not in much concern or interest to people during the financial crisis. Understandably, it was a very deflationary time period, and that's why the TIP ratio collapsed. And then as stocks started rebounding, then it was a good time to own TIPS over TLT. But since 2011, if you wanted to own bonds, it paid off much better to own TLT, because when this ratio goes down, it represents that TIPS are weaker than TLT. And then on the contrary, you can see over the last couple of months, the ratio is pushing higher. Ironically, the ratio just reached the exact same levels it did in the financial crisis. So some people are starting to buy into this, which they're thinking typically or historically has been they're concerned about some rate rising and a little bit of inflation cropping up. So if the dollar would happen to be making that topping pattern, this type of price action would make sense, and it would pay then most likely if this continues to own TIPS over TLT. I still think the German Bund is one of the best bond indicators on the planet, and this is what a 8-year look at the German Bund. And so for the first time since 2011, the Bund is making an attempt to break below what would we say, 5-year rising support. Momentum was very high and lofty, and it's been turning down. This is a weekly chart. I wouldn't say that a solid break has necessarily happened yet, I'm sorry I didn't include it in this PowerPoint, but we've done it before and we'll continue to send it. If we would zoom out and look back from the 1980s, going back 35 years, I want to reiterate that the Bund is still in a 35-year upward pattern. So just because we shorted bonds and have gotten lucky on that, you're not going to hear me say, hey, the low in interest rates, the low is there. Way too soon to tell. And I think, to me, one of the bigger signs would be is if the Bund would break a 35-year rising channel. I mean, it's probably the prettiest chart I could find of any asset that's just been going up at a 45-degree angle for 35 years. So you can see from a technical perspective, you break a 35-year trend, why it has my attention. So it has not broken it yet, but if it would, I think it'd sure signal. I don't know what, I'm not trying to say what rising rates over the last 90 days means. I don't want to go there because I just don't know at this time if it means anything. So going back to, now turning to the stock market, excuse me, this is our Fibonacci, well, a 4-pack we want to call it. But the top two charts are both the S&P. You've seen this many times if you've been a member since 2014. I've been sharing this chart for a couple of years. We continue to update it, and it's not my chart. It's just amazing to me the way it works. But what we did was, anybody can do, you can do it at home, is take the highs in 2007 and the lows in 2009, apply Fibonacci, and you can see the 161 extension level was resistance starting last year, 2015. We came back and we got a little bit above it. You know, we've had discussions before what constitutes a breakout, and just because it was 2 or 3% above the 2150 level for a little bit, I didn't really think that it had proven anything. And so now we find ourselves, this dotted line, as we've shared it before, is roughly the 2150 zone. You can see when I made that chart today, the S&P was around 2106. So now it's just a couple of percent below, and I wouldn't go and turn around and say, well, wow, it's really broke down, because it just hasn't. This is the S&P, but now we've applied Fibonacci to the crash lows of 1987, which was memorable, and 2009, and the 423 Fib extension level comes into play at 2150. So I think most of us would be hard-pressed, even in hindsight, to go back and find such long-term coincidences of Fibonacci extension levels coming into play. You do the same thing to the Dow on a monthly basis, excuse me, of the 07 high and the 09 low. You'll notice that roughly 18,000 is the 161 Fib, and the Dow was, you know, knocking on the underside of it, and then it pushed a little above it, and now it's back below it. So we can't say that really a breakout has taken place, and I won't go and say that a fake out has taken place, either. There's just not enough price movement on either side to say yay or nay on that. I do find it interesting that the lower right, this is the Nasdaq 100 on a monthly basis going back to the dot-com highs in 2000. So this is not a monthly close. This was the reversal wick in March of 2000. But if you just put a horizontal line, you can see how the Nasdaq banged up against it and went back above it. And so now the Nasdaq in this blue circle is literally testing the 2000 highs, high resistance, and last year's high levels as resistance, now as support right here. So a big test to see. This could tell us a lot. If we'd see tech start getting weak here, all of a sudden it would start smelling more like a fake out. It just tried to pull the last few people, in. And that I may have bored you with some of this, for a while. But when you think about all the trouble that the hedge funds are in, in this choppy market, I think, one of the lessons that we can all learn, if you can be blessed enough to see a choppy market going on, is just not do much with it, because it's kind of like watching sausage be made. They just say you don't want to do it. You don't want to participate in it. And that's what's happening to some of the people that are just trying to trade a whole bunch, through here. So I've tried to stay away from that so we can try to get nicked the least possible and try to be patient to see whether this thing, how it plays out. And I think we're really close, everybody, to getting some resolution. And like I said, next week, maybe that excuse. I shared with you a couple of weeks ago, this is the Russell 2000 S&P 500 ratio. Russell divided by the S&P RUT/SPX would be the ratio. And you'll notice that small caps remain in this down channel. In other words, since 2014, small caps have been weaker than the broad market. That's what's causing this to fall. Now, since just call it a year ago, roughly the beginning of this year, you see that the ratio was moving up, which reflected that small caps were stronger or moving up faster than the broad market. But as it hit this falling channel resistance here and these 2 points at 1, recently I went and shorted the Russell by purchasing RWM due to that resistance and then put a tight stop. So you can see of late with the line going down, which means that the Russell has been weaker, so we've been fortunate to at least be shorting one of the weaker pieces. I'm not really that hip on any large short exposures, right now, everyone primarily. Just so far we haven't seen the shoebox disintegrate. We haven't seen junk disintegrate. Now I did communicate with each of you this morning that PHK, which is the extremely high income ETF from PIMCO, that puppy lost almost 20% last month, and one fund does not constitute, in my opinion, an all-out signal. But when you start putting it with the junk space, look at J&K, HYG, the senior loans that we look at each week, and PHK, in just the last couple of weeks we're seeing a little bit of softness, not any giant deterioration or going against the market, but we are seeing a little bit of weakness. But I just wanted to kind of show, like today, I think the S&P was down around 70 basis points on the day, and I apologize, I hope I'm close on this. I think the Russell ended the day down a little bit over 110 basis points, so this ratio continued to go south, and we made a little bit of pocket change today in the Russell short. Here's the Russell short, RWM, that we own. Obviously it's had a terrible few years, especially when you look at it was 155 a share and recently was down to 50. So it's had a 2/3 haircut, but as was started watching closely as it was hitting potentially support here at the bottom of this bullish falling wedge, and we bought RWM, in other words shorted the Russell, and we've been slightly lucky over the last few weeks. No big trend has proven, other than we're just getting a little bit of price action, going in our favor. It can move up a little bit more. We'll bring up our stops to protect, the capital in that trade. Here's just a little peek of the Russell on a weekly basis that you can see as of right now, or last week, excuse me, everyone, it closed right on this support line. So really important prices that if it would slip here, again, this is support, this is 2016 support for the rally of this year. So what it does here is pretty important. We're already short here. If it would start rallying, we'll bring up the stops and protect that position. Potentially, is that a double top? I didn't draw it in, but the rally this year got almost up to last year's highs, and now we're fading. So could be important what takes place in the very near future. Here's the Nasdaq Monthly. We talked about it earlier, that the high spike, the spike back in 2000, you'll notice how it ran up to it again. This on a monthly basis last year several times, and we pushed above it, and now it's testing old resistance as new support right now. So important for the Nasdaq to stay up there. Another leading piece, this is the bank index, the BKX index. Financials, we've been discussing them quite a bit recently. We are long financials. One of the things is, we're trying to make a bet on the long financials, long energy, and short bonds. I was talking to some people at the Stocktoberfest meeting. I said, well, right now we don't have the bug on a windshield trade in play. And somebody said, what do you mean by that? Well, if a lot of people would think that the economy, the markets are about ready to become a bug on a windshield, you most likely would not have any long plays in. We do have some long plays with some tight stops because, right now with the AD line and all this still moving up, we want to take that shot. And we do have in the Russell short as a hedge. But this is, I think, just a really important price point here in the BKX index, that it's at its 78% fib retracement. And then there's this goes back to the financial crisis highs, and this is the 2011 lows. And you'll notice that financials, the rally this year, had come up and hit the underside. And again, this is in a downtrend. It's made lower highs for years, and now it has made higher lows over the last few years. But when we go back to the financial crisis, we still have a series of higher lows. So it's kissing the underside of, you could almost call it triple resistance right here at 1. So for the S&P to get above 2150, I think that they need the financials to keep doing well. Financials have outperformed the market over the last 4 to 6 weeks, but I really think they need to keep doing that if the broad market is to keep pushing a lot higher. Real quickly, this is the value line geometric that you don't see discussed very often, but it did catch my eye. This is a 20-year snapshot on a monthly basis. No short-term puppy here, and you just kind of wonder, is that a triple top taking place with a little bit of a fake out, last year. Now it is, like with all of the major markets, still in this 6-year uptrend, but it's kind of interesting. It tried to break out, looks now more like a fake out, and now it's created on a monthly basis a series of lower highs. And you'll notice right in here very tightly on a monthly basis, there's almost 2 doji stars back to back on a monthly basis just above this falling resistance. And then here is this past month, quite a bit of weakness in the value line geometric. So we're kind of looking underneath the hood here, and this series of lower highs is not real impressive. From a risk-on trade perspective, you'd want to obviously see this doing much better, not creating this series of lower highs. Kind of just to finish up today a little bit on the sentiment perspective, I was talking with Rick, and we both went to Stocktoberfest a couple of weeks ago, and it's just from a general consensus, great meeting, but from a psychological sentiment perspective, I can't remember the last time I've heard somebody talk about the market doing really well or much higher prices. I didn't find excess pessimism there by any stretch, a lot of neutrality, but it does surprise me that the market is close to some pretty high prices, in that you'll notice this is the American Association of the percentage of bulls, and casting a vote in the AAII survey, that is actually much closer to the lows that have taken place over the last 10 years than the highs. And it just kind of, I find it very intriguing that this is taking place. But again, some will point at the unknowns of the election or whatever, but the bottom line, outside of the election, I don't think there's too many times the market's been that close to a high the way that it is, and see so few bulls. So if the market would take off to the upside, obviously it would surprise quite a few people in the AAII survey, because it's only around 20% bulls right now. This is was from Sentiment Trader. Their overall, they take all the numbers, all the indicators that are showing excess optimism and also excess pessimism. They create a spread. Just so to notice that a lot of the indicators were showing excess optimism here just lately. So from an indicator perspective, it looks different. You see people, the indicators showing excess optimism, and markets have historically, especially over the last year, been closer at that time to a high than a low when you saw indicators up here. So you see them high, they're moving down some. So one of the things that when you think about beat up assets and assets that people, not many, like, from a hedger's perspective, from a sentiment perspective, it's understandable that a lot of people don't like copper. Copper's been down since old dot copper since 2011. You can see it was priced at almost $4.50 then, and there's almost a 50% haircut that's taken place. But this is a monthly closing chart, and I'm always looking for emotional turning points. It's not about the reasoning why copper reversed here or peaked there or any of these places. It's not behind the news. It's just, again, like we've been trying to discuss in today's call, it's about the reaction to it. So until broken, this is a 20-year support line. And being a monthly chart, you can see copper's been down here quite a few months, and ironically that this support line is being met by the 61% retracement level based upon a decade's move. This was based upon the 2001 lows and the 2011 highs. So we have a fib retracement level and a long-term support level coming into play, and very few people like copper. I believe it's in the low 30s on bulls. And the way the smart money, dumb money is set up is that it would be encouraging for copper prices, or suggesting that they could be moving higher. And if it does, it would surprise a lot of people. So from a metals perspective, maybe a macro perspective, if copper would come back and mean something to society, this would be a great place for it to rally for the risk-on trade. I don't think it would, obviously, on the flip side, if this sends a negative macro signal and it would break support here, one of the high-flying trades would be probably to short, obviously, JJC, which is just the ETF, or look at shorting Freeport-McMoRan if things did become very poor on the economic front, especially in the copper sector. As we start on a new month, I will be putting this in the email, but here was going back the historically strong stocks in November. As most of you have noticed a few times, we've shared, I know one thing that any of you are participating in investing in these markets, you're well aware that historically the old adage, sell in May and go away, well, that's a 6-month window. Well, the flip side of that is be a buyer in October and hold it till May. So traditionally the markets hit lows during this time frame. I know it's an election year and there's all kind of stuff, but outside of that, here are all the S&P 500 stocks. We've set the criteria that had to have 10 years, as we usually do. Wanted to be at least 60%, preferably 70% higher. And so here are the stocks that have done well with the median returns ranked from top to bottom, with the lowest a 4% gain and the best a 7% gain. What I'm going to do is put this into a couple of different 9-packs, for you, and let you look at the charts. But we're going to try to really focus in here on the top 5 or 10. And ironically, even Amazon traditionally, the month before Christmas, has done pretty well, with an average gain of 6% in November. 10 out of 10 times it's been up in the November time frame. Excuse me, the number of years higher is 80%. I'm sorry, and the number of years of data was 10. So we'll be getting this list to you, and if the market again next week, if that's the excuse, the election, and if the S&P would push above 2150 and start doing well for whatever the reason is, this will be one of the first places that want to look at some of these stocks that have traditionally outpaced the market even during the seasonal window. So I appreciate all of your time, your membership, your patience, your excitement, the great things and the communications that I hear from so many of you. I'm very humbled, by all of them. I just want to remind you that I may be doing another webinar just here in a couple of weeks. Just kind of depends on how some of this shakes out. I'm not going to be trying to share that one day after the election some knee-jerk reaction has solved everything for us, because I just don't think that's going to be true. But I do believe that some of the lethargicness, some of the narrow ranging could have a chance to end post-election here. Could easily be wrong on that, but we'll find out here next week. So I wish you all well, have some fun voting, and we'll see you on the other side. Thank you very much.